Predatory lending is any type of lending that exploits people. It's designed to take advantage of people. Many times it's deceptive. The practices will be unfair or abusive. They maybe have high interest rates or terms that are designed to take advantage of people and to get them to pay more than they need to pay, or pay more than what they would otherwise qualify for. In other words, you might qualify for a lower price or a better product, but you get instead a product that takes advantage of you. And usually these products are designed in a way that the bank makes money or the lender makes more money because they get you into a bigger loan or a higher interest rate or terms that are more advantageous to the bank and less good for the consumer. As a general matter, underserved communities are targeted because underserved communities have been denied good loans in the past, so they're ready to say yes. In that sense, they're vulnerable to these practices. But in particular, we know from past practices and we know from history that minority communities, communities of color, are typically targeted, deliberately so, because these are the communities that were historically redlined. That means they were denied the opportunity to get good loans, prime loans. And as a result, the lenders knew that these would be the communities that would be starved for credit, that wouldn't have trusted advisors or friends or experience with banks, wouldn't have a branch manager that they could go to and say, is this a fair loan? Should I do this? And they could be taken advantage of. And that's what has happened over time. It became such a crisis in 2008, 2009. So many people lost their homes that with the advent of the new administration at that time, President Obama came into power, and there were a number of people who came into positions of authority with regulators who said we need to do something from a regulatory standpoint to rein in the banks so these practices don't happen. And a couple of things happened. The first thing, most important, happened was that something called the Consumer Financial Protection Bureau was created. We call that the CFPB. And that, for the first time, was a very serious watchdog agency that was entrusted with the purpose and mission of actually regulating loans. So saying to lenders, if you're going to be in this space, we're not going to allow you to have prices that are going to be too high, terms that are unfair. And deceptive practices, abusive practices were cataloged, and consumers were forbidden. And a lot of what's called these subprime loans, these riskier loans, were literally outlawed. And as a result, a lot of this predatory lending started to dry up, starting in 2009. Absolutely. There are a couple of things that have happened and have, notwithstanding the improvements that we've had since the CFPB went into effect and some of these regulations went into effect, there have been practices that have continued unabated. One thing that happened is actually been a reaction to predatory lending. Now, what we called predatory lending back then was reverse redlining. And I have to back up a second. Redlining, as I mentioned, is the practice of drawing a circle around an area, usually an area of color, and saying we're not going to make loans in that neighborhood because we think that the people there are not qualified. And typically that was done historically based on race, based on national origin. That happened all over the country. Reverse redlining was a practice that began in the 2005, 6, 7, and even a little bit before that, where lenders actually, it's the flip of the same coin. Lenders said, we're actually going to go to those minority neighborhoods and we're going to target them for predatory loans because they will say yes and we'll make more money. We'll find vulnerable folks there. And so we're going to actually affirmatively target our bad loans there. So reverse redlining means targeting a bad product to a minority community or on the basis of color or race. And redlining is denying a good product to a community of color. And what happened was, when we had this new regulation that stopped a lot of the predatory lending, we had a drying up then of credit generally to minority communities. The reaction of the banks was, well, if we can't do subprime lending, if we can't do these risky loans, than to the minority community. Then what we are going to do is we're just not going to lend there at all. And they went back to doing what they had been doing for decades before, which is focusing on white suburban communities and saying, all right, we'll do good loans, we'll do prime loans in these places, but we think that's where we're going to find the qualified borrowers. So if we can't take the stuff where we make the most money, which is these predatory loans, into the minority community, we're just going to go back to the old redlining practices. So that was one bad reaction, and we saw a drying up of credit to communities of color, and that was a big problem. It has been a big problem for the last 10 years. We're still fighting the battles to get good loans into the minority community because we as advocates believe and say, and we know the data shows, there are lots and lots and lots of qualified consumers in communities of color. Of course, we all know that. And banks have a responsibility to find them and to serve them. Okay, that's number one. The second thing that happened was there was a resurgence of certain predatory practices that the CFPB didn't fully get a handle on. One of them was something called payday lending, which is a very, very dangerous and risky practice where there would be small operators that would make loans to people $500, $1,000, $200, and they would loan literally with an interest rate from day to day. And they would do it paycheck to paycheck. So you'd promise your next paycheck based on a loan you'd get to just pay a bill or make ends meet. But the interest rates, the annual interest rates, if you added all that up over the course of a year, can be 300%, 350%. And people get behind quickly, and they're promising paycheck after paycheck after paycheck, and they can't get out once they've started. Very dangerous practice. And what's happened is there's been an effort to regulate that on a state-by-state basis. The CFPB's tried to regulate it generally, but there's been a lot of pushback from the payday lending industry. So that still remains a dangerous practice, and consumers everywhere need to beware of these payday lenders. That's a dangerous thing. What we see are for-profit colleges. Now, there was one in Virginia, the Richmond School of Health and Technology, which was a for-profit college, a vocational school that purported to offer certificates and training for people to be physician's assistants or surgical techs or things like that, technical vocational training. It turned out that the program was an absolute scam. They did not train the students. Students couldn't pass the tests. Teachers didn't show up. They didn't have the books. They didn't provide the equipment that they needed. But at the same time, what they did was they were very aggressive. They would charge $10,000 to $20,000 a year in tuition. And they were very aggressive in getting the students to apply for federal student loans through Pell programs and other government programs. They would promote that. The school would promote that. The school would get the money from the loan, very much like, a predatory lender would get the money. And instead of selling the loan on Wall Street, the government would have the loan. So the risk of the student defaulting was not on the school. They got the money, which is the tuition, and they made an incredible profit that way. What we found with Richmond School of Health and Technology, and we filed a lawsuit in Richmond against them, was that they had deliberately targeted communities of color. This was for students who had graduated high school, and they said, hey, you'll get a great job, we'll get you a certificate, you'll be making $50,000 a year. Complete sham. Students would graduate, get nothing. They couldn't find a job. They couldn't get the certificate. They wouldn't pass their tests. They'd be behind $20,000, $30,000, $40,000 in debt. And these are student loans, and of course, the implications for a student, for your career, for your job, future job is disastrous. Meanwhile, RSHT, Richmond School of Health and Technology, was doing very well. They were making a huge profit. They pushed close to $5 million of loans a year through this way. And of course, the person who was paying for all this was the US taxpayer in these programs. So this is something that still is going on. These vocational schools, these for-profit lenders, a focus of the CFPB now actually, and others who are in state agencies looking at them for predatory practices. Yeah. Yeah.
So there you are, shuffling through a stack of resumes and you come to mine. This is it, first impression, my way in. But can my resume show you how I truly stand out? Like that I was studying, going to night school while working 2 jobs just to help my parents pay for groceries. Or being the first one to always step up. No, that's something you just can't put on paper. Look beyond the resume and discover new ways to develop great talent that is dedicated, hardworking, and determined like me.
Yeah.
And these are lenders who typically will bring together funders, that is, people who buy loans, and people who want to fund loans. Sometimes it's banks, sometimes it's independent sources. They bring them together online on a platform, and you can go to that platform. There's lots of them popping up. And you can go and you can say, yes, I'd like a personal loan of $5,000 or $2,000. And they'll call up your credit score and they will qualify you immediately for the loan. Now, some of these fintech companies work in the subprime space with these riskier loans. Others work in the prime space. We don't have any problem with those who work in the prime space or the near prime because they're responsible lenders. And what we're finding is they're making many times good loans. They're much better loans than the payday loans, and they're getting into the minority community. So they're making money available in the minority community, and they're penetrating those markets. But around the periphery, there are some of these fintech lenders that are not as responsible, and I'm worried that some of them are engaging in practices that may not be as bad as the payday lenders, but still there's the potential for abuse because people see it's very quick and easy and attractive, and there will be, a deduction straight out every month, straight out of your bank account. So you're locked in. You go in and you're locked in, and it can be maybe more than you can really afford. You want to make sure that whoever is talking with you, that you talk to a person. I personally believe that although there's lots of online lending platforms and the ways you can do things in an automated fashion, I think it's important to talk to a real live person. And then it's important to understand, are they giving you a fair shake? Are they really asking you about all your sources of income? Are they exploring where your income comes from? Are there other options? If they say this could be an issue, are they really working with you? A lender has a fiduciary obligation. That means an ethical obligation to try and help you qualify for a loan. And if you feel like you're being snubbed, like someone's not taking the time to be with you or simply dismissing you out of hand, that can be a warning sign, particularly if you are a person of color. That can be a warning sign that you are being prejudged. Is someone sitting down and taking the time with you? That's very, very important. And people really have a sense about that they're not being taken for full. The second thing I would say would be watch out for things such as there are certain signs where there may be, always ask, is there a prepayment penalty? In other words, if you want to pay off the loan early, is it the case that you pay a higher price to do that? There's going to be a penalty, a fee for doing that. Your interest rate's going to go up, or you're going to have to pay some sort of fee at the time that you what's called close the loan. That's important to look at. Does the interest rate seem high to you? It's always good to try and get another opinion, to walk to a competitor. Never take the first thing that comes, but always, a good shopper, say, fine, thank you very much. I see what you're qualifying me for, the price you want to give me on the loan, how many points I have to pay, which is a percentage of the loan at the time of closing. I'd like to take that to one of your competitors and see if they're going to get me a better deal. And almost always, if you come back and say somebody down the street is going to give me a better deal, if the lender wants your business, and that's a sure sign, the lender will say, wait, let me see if I can match that. The most important thing is they should complain. And the way you can complain is the Consumer Financial Protection Bureau has an online process by which you can file a complaint. That's important to do because that portal is looked at by the regulators, is taken very seriously, and there's a certain amount of transparency for that portal. So banks and other lenders learn that they are actually in the crosshairs of the Consumer Financial Protection Bureau. But you can also complain to any government agency, and in Virginia there are a number. You can to Fairfax Human Relations Agency, to others. You can complain to the government. The second thing you can do is there are advocacy groups which you can go get assistance from. Housing Opportunities Made Equal of Richmond, for example, is a great organization, and they have a lot of housing counselors. And if you've had problems with loans, you can let them know, and you should go there. And finally, there are civil rights organizations and civil rights lawyers like myself who we field a lot of complaints from people, both to give advice about where to go, what to do, but also if a case is an important case, we'll take it. And the Richmond School of Health and Technology case was one example of that. That came up through complaints that people had. There were students who came forward and said, we feel like we're being ripped off. And then ultimately there were former teachers who came forward and talked to us about the practices. So the point is, speak up. Speak up. That's the most important thing. I think we have made progress, though. I will say that we learn sometimes from crises, and I think that even though we went through a terrible, terrible crisis in 2008, 2009, and even though now the pendulum has started to swing back in the other direction with calls to lessen the regulation, to open markets back up again, notwithstanding that, I think some of these lessons are so seared into the public's minds, into responsible politicians' minds, that I don't think we're going to go back, at least immediately, to those practices. Now I think it's a more nuanced battle to try and make sure that what I call good money, responsible money, is flowing to qualified borrowers in minority communities and communities of color. And that is my thing. I think that, yes, we had lots of foreclosures that hit white folk and black folk and brown folk, all different races, religions, creeds, and so forth in this country in 2008, 2009. But we had a disproportionate amount of this predatory lending in communities of color. And I think one thing we have to do now is never forget that, and to make sure that we have programs that are focused on communities of color, because if you push folk down further, you have to be prepared to provide them more assistance, I think, to get back up to some level of equality, some level of fair play. If you push people, as I always say, if you have a race and you put some people in the race with a ball and the chain, and you say, okay, now run your race, and then halfway through the race you take that ball and chain off and you say, now everybody's equal, you can finish the race. Well, it's not going to be a fair finish, because for most of the people who started out with the advantage, they're going to end ahead. And I think that's a little bit what we saw in 2008, 2009 with communities of color that got targeted, so they got hit worse. And I think now, going forward, we need to have our responsible politicians focus not just on underserved communities, but on communities of color in particular, and make sure we have programs and that we monitor banks to make sure we hold their feet to the fire. Are you really doing everything you can to find people in those communities who qualify for your loan?